Hey everybody, Rowan Smith from the Mortgage Center. I want to talk today about lines of credit. It's been a while since I've done a post on it. I get a lot of questions on it, people not understanding when a line of credit is possible and what kind of rate they can expect. So first off, when is a line of credit possible? Well, you have to have 20% equity in the property. CMHC does not allow people to have an interest-only portion of their mortgage. So lines of credit are interest-only. Typically, prime plus 1 is the going rate, although your institution may offer you something better if you have a very large investment portfolio or a long-standing connection with them. But prime plus 1 is the baseline rate by which you should be judging any particular offers you're receiving for a line of credit. So if you've got a $500,000 home and you've got a $350,000 mortgage, you can only have 80% financing. That's conventional financing if you're doing one line of credit. Now in that case, that's $400,000. Well, if you've got 350, max is 4, the max line of credit that you're going to be able to get is 500. Now that's a secured line of credit at secured line of credit rates. Your institution or any other institution can offer you unsecured lines of credit all they want. And how big they'll go is generally an indication of how aggressive their policy is or how much debt they think you can service with your taxable income. To give you an example of how this plays into it, I had somebody who was looking to qualify for a $50,000 line of credit, but they needed 80. So they went to 2 different banks and applied for a $30,000 line of credit. And they were declined at both of them because unsecured, $30,000 is very large. For secured, you can have $3 million lines of credit if you've got the equity in the property. But when it comes to being an unsecured line of credit, the banks generally have a cap, anything over $10,000, and they start wanting to see a lot more net worth, a lot more fallback position, meaning vehicles, meaning cash assets, stocks, RRSPs, savings and whatnot. And you say, well, if I had the savings, I wouldn't need the line of credit. But in most cases, people need a line of credit as a contingency, not as the primary source of their funding. So there's secured lines of credit with your mortgage, can't exceed 80% of the value of your home based on an appraisal, not based on list prices of other properties in your area. And there's unsecured lines of credit, which banks can do whatever the heck they want as long as they believe you and believe your credit rating is strong enough and that your income can service it. If you want any clarification on this, please contact me. I'm Rowan Smith for the Mortgage Center.